والصلاة والسلام على سيدنا محمد وعلى آله وصحبه أجمعين. Distinguished guests, dear colleagues and friends, Assalamu alaikum wa rahmatullahi ta'ala wa barakatuh, and good morning to all of you. It is a great pleasure for us to be here to share with you one of the most important issues affecting Islamic banks recently. But before we start this really, let me thank the organizers and the Central Bank of Bahrain for allowing CIBAFI to hold this InFocus session on the impact of Basel III on Islamic banks. We have the privilege and the opportunity to have with us a panel of distinguished speakers that will share with us their experience on this hot topic, if we can say. Basel III, as you know, has been issued by the Basel Committee on Banking Supervision in 2010, following the financial crisis of 2007-2008, aiming to support and to enhance financial stability and resilience of the banks. But this, of course, it will apply equally to Islamic banks, where jurisdictions have to apply Basel III. The Islamic Financial Services Board, IFSB, has also engaged in 2010 in preparing the revised capital adequacy standard, which is Basel III equivalent to Islamic banks, and gave some guidance to Islamic banks how they could apply Basel III. Now, the issue is, in many of the jurisdictions, the IFSB standard is still not implemented. And some countries, they started implementing Basel III itself. They have a pipeline for implementation. So I will not tell you more really about this right now. We have the opportunity to have with us our distinguished speakers. So the session will go as follows. We have with us Mr. Andrew Cunningham, who will do a presentation on Basel III itself and highlight some of the key issues perhaps that may be affecting Islamic banks. And then we will be hearing from CEOs and senior management of the Islamic banks from different countries to tell us how they see it impacting their banks locally and their jurisdiction. And we have also the opportunity with us to have a Barak Banking Group representative who will share with us the perspective from multi-country point of view. So without further ado, please welcome Mr. Andrew Cunningham to give us his presentation. We'll be given 15-20 minutes to do this. Thank you, Andrew.
Thank you, Abdullah. Before I start my remarks, please allow me to say what a pleasure it is to be back in Bahrain. I've been coming to Bahrain for, believe it or not, nearly 30 years now, interacting with the banking and financial sector, and it's always a pleasure to come back, and it's always a wonder to see the development and advances in Bahrain every time I come here. I'm grateful to the sponsors of the conference and to CIBAFI for giving me this opportunity. What I will be doing in the next 15 minutes or so is to give you an outline of Basel III, the journey from Basel II to Basel III, and some of the points of Basel III that are particularly relevant, in my view, to Islamic banks. And then, of course, we'll hear from practitioners within the banking industry themselves about how they're dealing with those challenges. So, if we look quickly at the limitations of Basel II, Basel II was focused on capital, and it was issued in 2006. By the time of the global financial crisis in 2007 to 2009, the limitations and inadequacies of Basel II, there were many adequacies and good features of Basel II which remain to this day, but the limitations of Basel II were evident. The Basel II standards did not fully capture the ways in which capital could be compromised by losses. The capital, so that the numerator on the capital adequacy ratio was not fully loss absorbing in some cases, so one had capital, but it was not actually available to absorb unexpected losses, as it turned out. And perhaps most importantly, the Basel II Accord was conceived and prepared during times of very benign economic conditions. When Basel II was being prepared, no one thought that what did happen during the financial crisis could have happened. None of us thought that, if we're honest. And so Basel II turned out in some respects to be inadequate to deal with a major financial crisis. It dealt, as I said, only with capital. It did not deal with liquidity, which turned out to be one of the major issues within the global financial crisis. Nor did it look at macro-prudential issues. Basel II was a fundamentally micro-prudential document looking at the health of individual banks in the system rather than being focused on the health of the banking system as a whole. So if we move on then to say, well, what was the journey to Basel III? I fear some of you are going to have difficulty reading those slides, but hopefully that won't be too much of a disadvantage. So what did Basel III do? Well, among other things, it strengthened capital. So it strengthened the capital basis of Basel II. It strengthened the quality of capital, the numerator of the capital adequacy ratio, by ensuring that capital is more available to absorb losses. It extended the risk coverage of the denominator of that ratio, so that risks that we know were identified during the global financial crisis were brought into the capital adequacy ratio. And perhaps most important, it put a macro-prudential layer onto the treatment of capital through the counter-cyclical buffer, an additional layer of capital which regulators can impose upon banks if they see that an economy is overheating. And the key ratio that they use to determine that is credit growth to GDP. And within the Basel Committee, some very clever people have done regression analysis on a very large number of ratios, and what they have determined is that ratio, credit growth to GDP growth, and the jaws in that are a very good predictor of when an economy is overheating, when you're likely to see excessive asset price inflation. So Basel III includes a macro-prudential buffer, the counter-cyclical buffer, which enables regulators to try to choke off that rapid credit growth. The other thing that Basel III does is to introduce a simple leverage ratio of eligible capital to assets and some off-balance sheet assets, which are determined through a credit conversion factor, a simple leverage ratio which is set at 3%. The second thing that Basel does, so that's number one, the upgrading of capital treatment from the Basel II Accord. The second thing is to introduce new standards on liquidity. And let me just put a footnote in here. When we talk about Basel, I hope we don't talk about Basel regulations. They are standards. Basel has no regulatory power. The standards are incorporated into regulation by your local authorities, or in the case of the EU, by the European Commission and the Trilogue. So the Basel standards on liquidity were introduced as part of Basel III, and we'll talk a little bit more about that in a moment. There are two key ratios, the liquidity coverage ratio and the net stable funding ratio. A third thing that Basel III did, again from the macro-prudential point of view, was to introduce enhanced supervision for globally systemically important banks. It's also enhancing supervision for globally systemically important insurers. So these are institutions which can be considered too big to fail or would be very troublesome for the international financial community if they were to fail, and there is enhanced supervision of those. Now, let's remember that although we live in a Basel III world, many of the features of Basel II continue. It's not a case of Basel III coming in and throwing away Basel II. The three-pillar approach, Pillar 1 of minimum capital standards, Pillar 2 supervisory review, and Pillar 3 of market discipline remain. Many of the risk weightings that are used in Basel II to calculate risk-weighted assets remain. So much of Basel II remains with us today, but with an overlay that is Basel III. If we look at the key ratios that have come in through Basel III, and again I apologise if you can't see this, essentially we have 3 key capital ratios and 2 key liquidity ratios. So you have the total capital to risk-weighted assets. Again, we had that under Basel II. It has been strengthened under Basel III, in particular through the limitation of Tier 2 capital. You then have a greater focus on common equity Tier 1 to risk-weighted assets, minimum of 7%. So again, that's strengthening the quality of capital. And then you have the leverage ratio. So those are your 3 key capital ratios under Basel III. And then you have your 2 key liquidity ratios, the liquidity coverage ratio and the net stable funding ratio. And then you have other enhancements. And I've identified 6 enhancements, which include, for example, a focus on governance and risk management, and a focus on pay and incentives, on risk concentrations. And just to step back from this for a moment, if you think all the way back to Basel I, you had a single document that was about 30 pages. You then come to Basel II, you had a single document that was about 300 pages. But that was really it. You had the market risk amendment, dealing with market risk, but you could really summarise a lot of Basel II in a single document. That is now no longer the case with Basel III. You have the documents on capital, you have the documents on liquidity, you have documents on governance, you have documents on risk management, and some of these are coming out of bodies allied to Basel, not necessarily Basel itself. So the Financial Stability Board, for example, is producing work on pay and incentives and on risk governance. But the point I'm making is that Basel III is a very broad concept now. It's not a single document. I won't speak to that slide, partly because you can't read it. It's small. That is taken from a very good document produced by the Financial Stability Institute, which is the outreach arm of the Basel Committee on Banking Supervision. And the Financial Stability Institute works with regulators in emerging markets. And that is a table that they have produced on Basel III compliance in the Middle East. Saudi Arabia, just so we're clear, Saudi Arabia is not included in that because they're a member of the Basel Committee, and the FSI deals with emerging markets, and Saudi Arabia doesn't fall into that category. So that's why Saudi isn't there. But if you just look along the top, I'm going to take 1, 2, 3, 4, 5, 6, 7, 8, the key issues that Basel has identified, and we just have a quick look at are these issues, so these data points which the Financial Stability has identified as the key points in Basel III compliance. And if the FSI identifies them as key points, that means they are key points for us. The FSI has identified the liquidity standard, the liquidity coverage ratio. It hasn't put the net stable funding ratio in because it hasn't been applied yet. And as we'll see, with the liquidity coverage ratio, there are big issues for Islamic banks, big problems. The definition of capital, and I don't see that being a huge issue for Islamic banks, because as you know, Islamic banks do not issue complex hybrid debt. I'm aware of Tier 2 issuance being done, but Islamic banks tend to be reliant on very core capital. So new definitions of capital is not a major problem for them. Risk coverage is a third area identified by the FSI, and again, I don't see that as an area where Islamic banks are particularly disadvantaged compared to conventional banks. The capital conservation buffer, the counter-cyclical capital buffer, these 2 overlays where banks are required to hold more capital. Again, I don't see that as a problem for Islamic banks. I'll say more about that in a moment. Leverage ratio, again, the capital ratio, that shouldn't be a problem. And then you've got domestically systemically important banks and global systemically important banks. The global systemically important banks are not really an issue in this part of the world. Domestically systemically important banks are. It's an interesting point. Because let's suppose you have a hypothetical country where there are 2 Islamic banks in the system, and they have a market share of 15%, but let's say one of those is accounting for 80% of the Islamic market, is that a domestic systemically important bank? It's pretty important for the Sharia compliant community. So I just put that out there as something to think about. Let's move quickly on to key issues, and I've divided this into three areas: capital, liquidity, and other. And the capital, all I'm going to do is give you this graph. It's taken from the Banker magazine, and it shows the BIS capital ratios of a selection of Middle Eastern banks at the end of 2003. And there's I think it's 84 banks in there. And what you can see is that every bank in the sample showed a BIS capital ratio in excess of 8%, in excess of the minimum. Banks in this part of the world, including Islamic banks, tend to be well capitalized. And my view is therefore that capital is not a major challenge for Islamic banks within Basel III. In contrast, liquidity is. Some of you will be familiar with the liquidity coverage ratio, where you have the numerator, a stock of high-quality liquid assets, and then as the denominator, your net cash outflows over 30 days. And this ratio is attempting to understand whether a bank could withstand a stressed scenario over 30 days. Would it still be in business? Could it pay off its creditors after 30 days? And the Basel Committee defines three types of high-quality liquid assets, HQLA, that are the numerator on your calculation. And I've put some italics in that, and I think the presentation will be available after this session so you can see the details of this. It's not just a question of having highly rated instruments that you can buy. It's not just a question of having highly rated Sharia compliant instruments that you can buy. They need to be traded. You've got to have a liquid market. You can't say, well, I bought this highly rated Sharia compliant bond, but no one trades it, and I can use that for my liquidity. That's not allowed. Unless it's with your own central bank. With your own central bank. And notice the other area where I've put italics. Let's take the example of Turkey, which is rated BB- by two of the major rating agencies and BB+ by the other. Let's suppose that you're a Turkish bank and you're buying debt issued by the Turkish Central Bank in Turkish lira. Now you can count that in your high-quality liquid assets, despite the low rating of the Turkish Central Bank. You can count those with your high-quality liquid assets, but only to the extent that you have liabilities in Turkish lira. Let's transfer that to the situation in the Gulf, where you do a lot of dollar funding. Let's suppose you're in the UAE, okay? And you're buying bills off the Central Bank of the UAE in dirhams. You can't use that to cover your liabilities of dollar funding. It's got to be matched. So one can fairly quickly appreciate that there's going to be a problem there for some institutions in acquiring a sufficient quantity of high-quality liquid assets.
5 more.
Yep. So I put the challenges of using the microphone. I put the challenges of high-quality liquid assets in three ways. Most of the universe of highly rated bonds, which is what banks typically use to manage their liquidity, most of the universe of highly rated bonds may not be held by Islamic banks because they bear interest. Sharia compliant high-quality liquid assets are often not issued in sufficient quantity to enable you to meet your liquidity requirements. And beyond that, even if you have the availability of the assets of high ratings, Sharia compliant instruments may not qualify as high-quality liquid assets because they're not traded in deep and liquid markets. I'll just say one more thing on that, which is that the Basel Committee recognises that some jurisdictions may not just those in Muslim countries, but some jurisdictions in emerging markets, there may be insufficient high-quality liquid assets to enable banks to meet the liquidity coverage ratio, and it makes a specific reference to Islamic banks in paragraph 67 of the liquidity coverage ratio, liquidity and risk monitoring tools document of January 2013. And my final slide has got these documents labelled. I think in the interest of time, I better jump over the net stable funding ratio and we can come back to that. I've put some statistics on the liability structure of banks in Qatar in the presentation. The reason why it's Qatar is because the Qatar Central Bank has required the banks to either be Islamic banks or conventional banks. You can't mix it up. And therefore, it's a very good case study to compare the balance sheets of Islamic banks and conventional banks. You can't do that anywhere else in the GCC. And the reason I put those numbers up is to try to make the point that when we talk about liquidity, we've got to be rooted in numbers. We've got to get statistics behind it. And if you look at the statistics, you can see that there's no clear picture emerges. You can't say from that, well, clearly Islamic banks have shorter-term liability structures than conventional banks, at least based on that sample. So it's a complex issue, liquidity, and we need to root it in numbers. The other issues, so we've looked at capital, we've looked at liquidity quickly, and the other issues are identified are governance, risk management, pay and incentives, risk concentrations, and off-balance sheet exposures and securitizations. I won't go through those, but I'll make a general point about all of them. We often talk about the differences between Islamic banking and conventional banking. Let's also remember that there are significant similarities. Islamic banks have assets and liabilities that must match. You get from one reporting period to another through a profit and loss statement. Islamic banks fund themselves through deposits or instruments that are structured and have reserve requirements in a way that enable them to operate effectively as deposits. Profit-sharing investment accounts operate effectively as deposits. And they fund their customers' needs. And many of the challenges that Islamic banks face arise from counterparty risk. That is, that counterparties don't do what they're supposed to do. For a conventional bank, that is, customers don't pay back their loans on time, and for an Islamic bank, customers don't adhere to the contract on when they're supposed to make payments. So there's huge similarities between Islamic banks and conventional banks. And so as you look at those issues, like governance and risk management, one has to ask oneself, are there differences due to the fundamental structural aspects of Islamic banks, or are there just minor differences in emphasis? And I think in governance there are some fundamental differences concerning the role of the Sharia board, for example, and the rights of investment account holders. But if you look at the other issues, I don't see that Islamic banks are really dealing with a fundamentally different set of issues than conventional banks. So that is my overview of Basel III rather quickly. I've put in Appendix 1 just some statistics on the Central Bank of Bahrain's Treasury bill issuance. Again, just to make the point about when we talk about liquidity, let's get some numbers behind it and then have a conversation. And those are some of the key documents issued by the Bank for International Settlements related to Basel III. Thank you.
Thank you, Andrew, for this comprehensive presentation. We see, I think the Islamic banks are certainly dealing with same issues, but are they impacting them the same? That's what we will be hearing from our panel here.